This video is about investing during retirement. Investing during retirement, it's different from investing before retirement, right? When we're investing before retirement, we've got those steady paychecks coming in. We feel like if something does happen, at least we've got that coming in and we can save more money or work longer or make adjustments as we need easier when we have those steady paychecks coming in. But when we're investing during retirement, we've got a different game going on. So in this video, I'm going to share with you some things that I learned about investing during retirement. Hi, I'm Camille Gaines, and here and on my website, retirecertain.com, I write about and talk about what I've learned since we stumbled into early retirement a long time ago, way before it was vogue. And I'm not a financial advisor. I am a financial coach, and I have some investing courses on my website. But please don't take anything here or anything you see on YouTube, period, as personal financial advice. Everyone's situation is different. Okay, so the very first thing I want to share about investing during retirement is that I've already touched on it just a bit, is that the risk feels differently. And we have to be aware that we have that bias. We have to be aware that we are a little more on edge about our investing. There is a little bit more of that tendency to keep all our investment assets in under the mattress, right, to keep it safe because we don't have those paychecks. So be aware that this bias exists and do what you can to avoid that bias interfering with the investment returns that you get. The second thing I'll say is to understand your investments. I'm shocked by the number of people that I see that are thinking of retiring or getting ready to retire, and their decision to retire is based on the fact that their financial advisor said that they could retire, but that they don't know their financial advisor said they could. They don't understand their investments really well enough to know. So it's not that hard. It's not rocket science. I'm not that smart. Really, there's just a few asset classes, and learning about why you would own those asset classes and when you would invest in them and what the risk and rewards are of investing in those asset classes. It's not that complicated, honestly. Maybe a day of learning, couple days of learning at most, a few hours, afternoon, 2 afternoons, and think about a game of golf or gardening for the afternoon, cleaning out your flower beds and mulching them, which is my current pastime. Compare that to investing and learning about investing and really understanding your investments, and you'll see that that is time really, really well spent. Okay, the next important thing about investing during retirement, super important, is to invest from an overall plan. You probably, hopefully, have a retirement plan where you've put your numbers into a calculator, and this could have also been done with a financial advisor, but live from, invest from, spend from that overall plan. Math doesn't lie, and while most of these calculators, all of them, we've got to put in probabilities, we've got to put in estimates. We don't know for sure what's going to happen, which I'll talk more about in a second. When we do at least work from the estimates, we have those estimates, we have a plan, and we can live from, invest from that plan during retirement. The next really important thing about investing during retirement is understanding the probabilities that the plan you created, whether or not or how likely it is that it will play out. So again, those plans are all based on estimates. They're based on how long we think we'll live, what kind of investment return we think we'll get, and that's it. We don't know what the future holds and over what time frame. We've got things like sequence of returns risk that really affect whether or not our investment plans, our retirement plans, will play out as we had hoped during retirement, and that just means that if there's a bear market in stocks shortly before or after retirement and you're planning on a standard sort of stock bond investment plan for retirement and there is that bear market, then sequence of returns risk, numbers have shown, the data has shown that your plan cannot work at all if that bear market happens shortly before or after retirement. So be aware of the probability that the plan will work out as you had hoped, and have a plan B for if that plan doesn't work out. Even if we look at investment plans or retirement plans, they're usually, it'll usually be, well, there's a 90% chance this will work out. Okay, well, what about the 10%? What about the 10% where it doesn't work out? That's where we want to have a plan B for our investing during retirement. The next thing that I would recommend for investing during retirement is just to set a date in your calendar where you're going to check and see how you're progressing toward that plan that you've set up. Are you getting the returns that you need for that plan to play out, for you to be able to have those funds for life that you hopefully are planning on? Or do you need to change your plan because something has not played out? You didn't get the returns that you thought you would get. Or maybe you've gotten better returns than you thought you would get, or you got some kind of windfall or large capital gain and came into more money than you had thought that you would. And maybe you can free up your spending a little bit and relax a little bit and enjoy life a little bit more and get some things that you always wanted. So check your progress at set intervals. Check up on that retirement plan and see how you're doing and see if you're on track to achieve that plan that you set in place. The next important thing for investing during retirement is to make changes when you need to make changes. It's so easy to resist or to delay or avoid making changes to our investments. They are normally and hopefully always sort of really, really important but not urgent. They fall into that time management category of important but not urgent. Make them really, really important but also time critical, because every month that goes by can turn into a year and then years, and we haven't made the changes that we really meant to make a long time before. So make changes as you need to your plan, to your investments, so that you can get the results that you want. The next tip about investing during retirement is to avoid more risk than you're comfortable with. It is so easy to feel like you're a victim to the stock market. It feels out of our control because it is out of our control. But what we can control is how much money we have in the stock market. So what I like to do with my financial coaching clients is have them add up everything that they have in the stock market and then say that amount times, multiply it by a certain amount. You can use the average of bear markets from past, that's somewhere around 30% now. You can just say, okay, if I get the average of past bear markets, if I take that kind of hit, what will happen to the stock portion of my portfolio? Now, you might have bonds in there in the past couple of decades, 3 decades, when stocks have gone down, bonds have gone up because there was that flight to safety. But we saw in 2022 when both stocks and bonds fell in unison. I've done another video outlining the details and the history about the correlation between stocks and bonds. And prior to 1990, stocks and bonds were correlated more often than they were not. In other words, they moved in the same direction. In other words, when stocks went down, Treasury bonds went down. Okay, so that is not written in stone, as I personally used to believe, and I was taught in my financial courses. That is not always the case. So we can know that sometimes investors do. There is a flock to safety, and investors do drive up the prices of U.S. Treasury bonds. And when stocks tank, those bonds can go up. But that's not always the case. So keep that in mind. And back to, went on down a little rabbit hole there. Back to taking the total amount you have in stocks times whatever amount you feel like the average annual bear market decline is around 30%. We've had a couple little blips over the last decade that's kind of changed that average. It used to be about 33%, and now I think it's a little bit less because we had those 2 tiny little sort of bear markets in the late 2000s. But somewhere around there. But then we also have to remember that, the NASDAQ fell. Some numbers show 72%, others show 78%. That was from the tech bust. So that's huge. The S&P 500 fell about 55% from the 2008, that bear market. So look at your investments. Are they high tech? Are they technology stocks? Are they stocks that are less likely to take a massive tumble during a bear market. Use some sort of number, come up with some sort of number that you can use to estimate how much you think your stocks might fall during the next bear market, a significant bear market, not just the little blips, but significant bear markets like we saw in the 2000s decade. And then multiply that out and come up with a number and say, I can live with that. I can live with that kind of loss. Or no, I can't live with that kind of loss, and I need to research, find a better investments, do something that doesn't invest through bear markets, which is what I do. I don't ride out bear markets. I actually use a more tactical investing strategy that was professionally developed. I've researched the decades of back testing and saw that it really worked well for me. I've done another video, multiple videos about that if you want to check those out. But see if this is something that you are okay with, and you can make adjustments accordingly if you need to make adjustments. So always be aware of how much risk you have. And when you do this process, you no longer feel like you're a victim to the stock market. You actually have made a choice for how much risk that you want to have based on sort of a logical conclusion about what's happened in the past. And even though we know it's different going forward, it's always important to point that out. We know that we can use an average, or we can use worst case or scenario in our numbers and in our calculation. Those are the tips for investing during retirement that I found to be true in working with my coaching clients. And remember, retire certain.